Most retirees are terrified of losing their savings to a stock market crash, a scammer, or some unexpected emergency. But the truth is, those dramatic disasters aren't the biggest threat. What actually drains retirements the fastest is far more subtle, a $500 mistake that doesn't look dangerous at all. It's the kind of decision you barely notice, skipping a form, delaying a sign-up, choosing convenience over planning, and it seems harmless in the moment. But years later, it quietly snowballs into tens of thousands in lost benefits, surprise taxes, and missed income. And by the time you realize what happened, it's usually too late to fix. The mistake could be as small as claiming Social Security a few years too early, enrolling late in Medicare, or forgetting a required distribution from an IRA. Each one might feel like a minor oversight, maybe worth a few $100. But those small cracks in your retirement plan can open wide, draining your accounts far faster than you ever expected. Worse, no one warns you about them. They don't show up in bold print. Financial institutions rarely flag them, and your monthly statements won't scream that something's wrong. That's why today, we're pulling back the curtain on the real reason many retirees run out of money sooner than they should. It's not bad luck. It's small, preventable missteps that snowball into massive losses. So stay with me, because once you understand how a single $500 decision can spiral into a $50,000 loss, you'll never look at minor retirement choices the same way again. There's a reason the IRS doesn't send reminders about your required minimum distributions. They're counting on you to forget. And when you do, they're more than happy to collect. One of the most common and costly retirement mistakes happens when people miscalculate or completely miss their RMD. It might seem like a minor oversight. Maybe you forgot to take the full amount or pulled from the wrong account. But that simple slip can trigger a penalty of 25% on whatever you did withdraw. Let that sink in. If your RMD for the year was $10,000 and you only took out $9,500, you now owe $125 to the IRS just for missing $500. And it doesn't stop there. You'll still owe the regular income tax on that $500, and if you don't catch the error quickly, interest and more penalties could pile up. Worse, many retirees don't even realize they've made the mistake. If you have multiple IRAs, it's easy to assume you can take the total RMD from one account, but if you apply that rule to 401k, S or different plan types, it doesn't work the same way. Each account has its own rules, and taking too little or from the wrong one counts as a miss. Financial custodians may help calculate your RMD, but they won't take it for you. And if you've inherited an IRA or rolled over funds mid-year, the math gets even trickier. One small misstep, worth maybe $500, can snowball into a massive headache, draining thousands from your retirement if you're not watching carefully. This is how small cracks in your plan start to widen, and it's only the beginning. There's a quiet window in early retirement when your taxes are lower than they've been in decades and lower than they'll ever be again. It's the perfect time to make a move that could save you tens of thousands down the line, converting traditional IRA money into a Roth. But here's where the $500 mistake happens. Too many retirees skip Roth conversions because they think the upfront tax bill, often just a few hundred or a few $1,000s, isn't worth it. They'd rather avoid the immediate cost than plan for the long-term impact. And that hesitation becomes one of the most expensive financial decisions they'll ever make. Roth conversions are taxed as ordinary income. So yes, converting $5,000 might cost you around $500 in taxes today, but every dollar you shift into a Roth grows tax-free forever. That means no RMDs, no income tax in the future, and no surprise tax jumps if your Social Security or Medicare premiums get hit later. Miss this window, especially before age 73 when RMDs start. And you could find yourself in a much higher tax bracket later in life, when large required distributions push your income up, whether you want them or not. Add to that the risk of a spouse passing away, which can throw the survivor into single filer brackets with higher taxes on the same income. Suddenly, That $500 savings in skipped tax becomes a $50,000 plus problem in lost Roth growth, higher taxes, and Medicare premium surcharges. It's not the cost of the conversion that hurts you, it's the cost of waiting. And it's one mistake that can quietly unravel the efficiency of your entire retirement plan. Most people assume they've got plenty of time to enroll in Medicare, but what they don't realize is that one missed deadline can trigger a penalty that sticks with them for the rest of their life. This isn't just a minor inconvenience. It's a $500 mistake that quietly compounds into tens of thousands in unnecessary premiums, all because someone waited too long or simply didn't understand the rules. Here's how it happens. If you don't sign up for Medicare Part B during your initial enrollment period, usually the 7 months around your 65th birthday, you could face a permanent 10% increase in your monthly premium for every 12 months you delayed. That might sound small at first. Let's say your Part B premium is $174. If you're just 1 year late, you now pay an extra $17.40 each month. For life. But it doesn't stop there. Wait 2 years? That's 20% more every single month for as long as you're on Medicare. That adds up fast. And it gets worse if you also delay Part D for prescription drugs. That penalty can rise by 1% of the national base premium for every month you're late, also for life. Many people make the mistake of assuming they don't need to sign up yet because they're still covered by COBRA, retiree insurance, or a health marketplace plan. But Medicare doesn't count all of those as creditable coverage. Miss the window and the penalty kicks in, and it never goes away. What looked like a smart delay to save money now locks you into higher costs every year of retirement. And that's just the beginning of the ripple effect. Many retirees try to play it safe by pulling only small amounts from their retirement savings each year, just enough to cover the basics, maybe a few extra comforts. It sounds like a cautious plan, right? But what they don't realize is that this overly conservative approach can backfire in a way that quietly costs them far more than they ever expected. This is where another version of the $500 mistake creeps in, not in overspending, but in underspending. Let's say you limit yourself to a tight budget, withdrawing just $500 less per month than you could comfortably afford. You think you're protecting your savings, but over time, the quality of your life starts to shrink. You skip trips, you put off medical care, you avoid replacing that aging car or upgrading your home for better safety and comfort. You delay joy in the name of preservation. And then what happens? Often, retirees reach their late 70s or early 80s with more money than they need, but far less mobility, energy, or time to enjoy it. What could have been an unforgettable chapter of life becomes one of missed opportunities. Worse, that safe strategy can also mean you die with more money left over than you intended. And if you haven't done proper estate planning, a huge chunk of it might end up going to taxes instead of your loved ones. Being too cautious might not trigger a penalty from the IRS, but it can steal something just as valuable, the best years of your retirement. And once those years are gone, you can't buy them back, not with any amount of money. It sounds harmless enough, taking out a small loan from your 401k, because you plan to pay it back quickly. Maybe it's just $5,000 for a home repair, a family emergency, or an opportunity you didn't want to miss. After all, it's your money, right? You're just borrowing from yourself. But here's what too many retirees don't realize. That small 401k loan can spiral into a massive financial setback if anything unexpected happens. And in retirement, surprises aren't rare. The IRS allows you to borrow up to $50,000 or half your vested 401k balance. Whichever is less. You repay yourself with interest, which sounds smart in theory. But here's the catch. If you leave your job or retire while the loan is still outstanding, you typically have to pay it all back within a short window, often just 60 days. Miss that deadline, and the entire unpaid balance is treated as a distribution. That means full income taxes due immediately, and if you're under age 59 and a half, you also get slapped with a 10% early withdrawal penalty. What started as a small loan maybe just a $500 monthly repayment plan, suddenly becomes a tax disaster. Imagine borrowing $20,000 late in your career, then retiring earlier than expected due to illness, layoffs, or a buyout. Now you owe thousands in taxes and penalties, all because of a decision that felt like no big deal. And even if you avoid penalties, pulling from your retirement early stalls your portfolio's growth, interrupts compounding, and throws your income plan off course. A 401k loan isn't just a quick fix. It's a ticking clock with real consequences, and too many retirees don't hear it until it's too late. It's easy to believe that the biggest threats to your retirement are obvious: market crashes, inflation spikes, or massive healthcare bills. But as you've just seen, some of the most damaging mistakes aren't loud or dramatic. They're quiet. They start small, like a $500 misstep, and slowly snowball into tens of thousands in lost savings, higher taxes, missed opportunities, or lifelong penalties. And the worst part? Most of them happen not because people are careless, but because they're trying to do the safe thing: skipping a Roth conversion to avoid taxes now, delaying Medicare enrollment by just a few months, choosing not to spend a little extra from your savings because you're afraid of running out, borrowing from your 401k thinking you'll pay it back before it becomes an issue. These decisions seem small in the moment, but they add up fast, and not just financially. They affect your freedom, your quality of life, your ability to say yes to the things that matter most while you still have the time and health to enjoy them. Retirement isn't just about making your money last, it's about making your life meaningful. And that means paying attention to the hidden traps, not just the obvious threats. If you've recognized any of these silent financial missteps in your own planning, the good news is you still have time. These mistakes don't define your retirement unless you let them. What you do next, the adjustments you make, the risks you avoid, and the opportunities you seize can rewrite your story. And if this video helped you see your future a little more clearly, don't keep it to yourself. Like, comment, and share with someone else who might be one decision away from a better retirement.